Vinit Sambre now joins us, Head of Equities of TSP Investment Managers. Vinit, good morning. Thanks a lot for joining us. What a stunning move it's been. Your thoughts? Is this time for fund managers like you to just sit back and enjoy the party while FIIs are chasing this market?
So I think anyways we as you know, as equity mutual funds, by and large we are always invested into equities, but this time around what I understand is that even our funds and across the industry the cash levels have been slightly higher, which is waiting on the sidelines. And in fact even the FIIs, what we understand, were waiting on the sidelines, waiting for the elections to get some certainty around stable government, and then the money was supposed to sort of have come in. But because of the changing narrative, because of the changing opinion, I think they have sort of taken this view. Also it is linked to money flowing into emerging markets. We have seen many of the regional markets getting flows, and India was lacking that. In a way, relatively, India was looking slightly more attractive versus the region, and I think that's one of the reasons. My sense is that we may continue to see volatility probably till the elections, because while macro and the top-down may be looking good, but when we look at the micro picture, the fundamentals are slightly deteriorating. We are seeing demand slow down across few segments. And hopefully these demand trends should strengthen post election. So I think till such time we have the slowdown being sensed across few segments like automobile, infrastructure. Now even some of the consumer staple companies have hinted at some slowdown in the rural areas. I think those are going to create the fundamental imbalance, and which is where we believe that the volatility could continue in the category.
Okay. Good morning, Vineet. Well, actually, it appeared when we looked at the mutual fund inflow numbers that there won't be so much cash put aside for the domestic fund managers. However, have the flows in the past few days, changed tack? Have they started flowing in? Looking at the runaway rally in the market, you think?
We've not really seen a big change of late. Only little change what we are observing is the small and mid-cap funds have started witnessing slightly higher allocation, is the sense we are getting. But others we've not seen a big trend change as yet.
Okay. Vineet, hi, good morning. I want to ask you about individual pockets and sectors as well. But before that, is there a pre-election play underway as well, according to you? And if the ruling party does come back to power, will there be, a premium attached to India, especially from, for continuity of leadership? I mean, from a foreign investor standpoint?
See, I think the observation from the past has been election results and election outcome has very shallow shelf life, and eventually people tend to follow the fundamental, people tend to follow the growth which any economy actually projects to show. And my sense is that election will be one event which will be watched very closely. A strong and stable government at the center is very important for the continuity of reforms and continuity of growth. And once that takes place, I think the fundamentals will tend to catch up, and everyone, including the foreign investors and the domestic investors, will pay a lot more attention to that. And on that, my sense is that fundamentally we have been in a low growth phase for many years, and hence once we have stable government at the center, reforms continue. I think that will mean growth continues, and that would basically drive money flow into equities.
Vinit, I asked this question yesterday as well to one of my guests. I'm asking you, are we likely to go through a bit of a melt-up phase in the market, which makes the market once again a bit top-heavy, driven by this huge FII inflows? I mean, every day we're seeing massive delivery buying in 5 or 6 select names. Can this make market once again a bit narrow and create that risk that we had last year as well?
So as I said in my earlier comment, I think what is happening is that the micro picture is still to emerge stronger, and which is where what you say is that as more and more money gets pumped into the stocks, the stocks tend to go on a slightly higher range of the multiple curve, and that is where the risk keeps getting created, and that is where rise in terms of the volatility is expected. But as these micro trends change, as the earning numbers start supporting the rally, I think that is where we will see some level of consistency. But I think till then, I would sort of concur with your views that the volatility would remain, and the multiple also will be slightly on the higher side.
Okay. Well, Vineet, over the past 2 days, we've been getting some bit of a negative opinion on the four-wheelers. Yesterday, Nilesh Shah of Envision was telling us that he's just a bit worried that four-wheelers may not pick up given the, preference for Uber and Ola. I also had a bunch of economists saying that the steamy growth that we saw earlier in the decade is perhaps over for a large number of consumer durables. Would you still bet on autos at all? I don't see them in your list, actually.
We have exposure to some of the auto names and also the auto ancillary. And the way we are sort of thinking about the whole auto sector as such is that there is going to be a big regulatory change. And we all are aware about the Euro 6 norms which are going to get implemented in April 2020. So the sense here is that the auto sector will see one demand up move before that gets implemented, because there should be pre-buying before that, and post those norms are implemented. I think the auto sector will see because of the hike in the prices to meet the new norms, auto sector may again see a bit of a slowdown. But my sense is that overall, if we look at the long-term trends here, auto sector tends to remain, beneficiary of the rising income levels of the consumer, the rising aspiration levels. By and large, our penetration is lower. So the long-term story remains intact. We have a lot of ground to capture here in terms of the low penetration. And hence we continue to hold a positive view, but only tactical thing about this would be that we will have to go through these cycle before the new norms get implemented and after the implementation. And I think that's where one will have to position themselves more tactically in the sector.
Okay, by the way, the big moves coming in the banking space now. Out of the 65-point Nifty rally, about 30 points is coming in just from these three names, Kotak Mahindra Bank, ICICI Bank and HDFC Bank. In fact, Kotak itself is providing about 13 odd points to the Nifty's up move. So looking pretty solid
and
for the banking
are adding
space.
up, look at L&T Finance Holdings. This is a financial move. Money is moving to financials. There's so much working for the financials, and this is what we discuss as well. Focus on the bank Nifty, focus on the financials. Yeah. That's where,
that's
the buying is. Yes.
In fact, I wanted Vineet to come in on that because, in your mid-cap fund, you do have a high exposure, Vineet, to the NBFC space, whether it's names like Edelweiss, Manappuram Finance, a couple of others as well. Do you think the worst of the liquidity crisis is now behind us? And what kind of growth targets do you have for this sector?
I don't think that the worst is still behind. We will have to see through the next 4-5 months really before we start commenting on the strength of these NBFCs coming back or the liquidity challenges abating. But my sense is that we have been selective in terms of owning a few businesses where we felt that the liquidity issue is not going to hurt them as much, where the business metrics tend to remain strong, and these NBFCs, some of them have the pricing power. So I think it is, it makes a case to be selective as far as NBFC is concerned. But by and large, as a category, I think the category is going to see some, is likely to see some more pain, and we will have to see how they perform for the next 4-5 months, and beyond which is where one will be able to take a very top-down view around the NBFCs.
Okay. Just for one last question, for the year, would you be on, what would your mid-cap, large-cap split be?
Sorry, I didn't understand.
How much of your pool would be in large caps and how much in mid caps, if you have to bet your own money?
Okay, so I generally favor mid caps and small caps because of a very simple fundamental belief that mid caps, by virtue of their small size, their ability to grow at a rate higher than the large cap is inherent in those businesses, and hence I typically tend to favor mid caps more. And personally, if you ask me, for this year or many years, I think mid cap having more than 50% type of a positioning of your assets is still okay, but only caveat there being that one has to be very careful around which companies are one buying. We have to focus on fundamentally strong businesses, strong franchise, and that's I think the secret sauce really, in terms of if one has to achieve success by investing into the mid cap as a category.
Manager, I take your point. Thank you very much, Vineet Sambre, for joining us with your thoughts this morning. Well, the market's still going strong, especially the Nifty Bank, 350 up on that index. And the top 4 gainers, contributors in the Nifty itself are Kotak Bank, ICICI, IndusInd and HDFC Bank. Such is the contribution from the Nifty Bank today. But today, for the moment, we're moving away from banks and looking at, well, we're still a distance away from holiday season. But this stock is almost evergreen. The Indian hospitality industry anyway seems to be at an inflection point on account of favourable demand-supply dynamics, experts tell us. But to understand more about how Indian Hotels is benefiting from this, we are touching base with the management of that company. It's a company that rarely speaks to the media and therefore very important to get a sense of how things are panning out. Puneet Chhatwal, Managing Director and CEO of Indian Hotels, joins us. Good morning, Puneet. Thank you very much indeed for joining us. Well, first up, just tell us how's business. We are given to understand that there's a spring in the step. How has occupancy done at the various Indian Hotels brands in the past 9 months?
I think we've been very blessed. The occupancies have been up, the rates have been up. Our revenue that we reported for the 9 months, especially in the third quarter, went up significantly. So year to date, we are looking at a double-digit growth in revenue and almost a 27% increase in EBITDA. We are witnessing also a very healthy growth in the upper upscale and luxury segment, and 70% of our portfolio trades in that positioning, which is really helping us to drive performance, because any increase that comes as an incremental increase on top of the on the top of the rates actually trickles straight to the bottom line.
Okay. Puneet, hi, good morning, and thank you so much for joining us. Can you give us some projections on what the room addition could look like over the next 6 to 12 months, and what would the capex plans be of the company?
Well, we have added 22 contracts to our pipeline in the current financial year, and we hope to continue with this trend, and our ambition is to open a hotel every month commencing next financial year, and most of that will be on a management fee based model. It's not our own investment, so which will help us balance our portfolio. We are very confident that this growth will actually help us achieve what we called our Aspiration 2022 in increasing our margins by almost 50%, coming from a 17% EBITDA margin to 25%. And growth in our portfolio is a very important pillar of this journey.
Okay. Puneet, you said that you're 70% exposed to premium luxury hotels. But for the remaining 30, is there now more severe competition coming from the likes of Oyo or Airbnb, are margins crunched over there?
I think the competition is always there and competition is healthy. However, we would like to believe that, real hotel brands is different than the ones which you have mentioned. So we do see a very big opportunity in that segment with our Ginger brand, which we've completely revamped in the last 6 months, opened the first Ginger in the lean luxe segment, as we call it, in Panjim in Goa. And I think 10 more will follow this year and see kind of a refurb over the next 12 months, 18 months. And I think that will revolutionize the positioning of this brand in this segment and lead a branding charge on the Indian subcontinent.
But what's the positioning of Ginger and the non-Lux brands, I mean non-super Lux brands? Is it more business customers they cater to? Are they that dependent on holiday customers in the first place?
I think over the last few decades, Indian Hotels has done quite well in creating several leisure destinations. So our portfolio is very well balanced in terms of having a significant presence in Goa, a significant presence in Kerala. We just opened a resort in Andamans. We're going to take over another property, as we announced, the Siddharth Goa, as of April, again in Goa. We own almost the Palaces market in Rajasthan. So I think our portfolio that way is quite balanced, and we need both. We need the business travelers and we need the leisure travelers. And we witnessed a very healthy growth in the leisure segment, especially in December. And we are hoping that we'll benefit from that in the holidays post-Holi and also during the Easter break in our leisure destinations.
Okay, now we are feeling a lot of wanderlust after you spoke about those amazing properties. But Puneet, you did mention that you're looking to increase margins from 17 to 25% by 2022. Can you tell us how you plan to do that on the operational front? In the sense, are you looking to cut costs? If yes, by how much? And also, are you looking to turn around or close any of your loss-making properties?
I think there is not one single formula that works like this. So it's a little bit of a science in our ability to grow the margins. But you rightly said that it's very important to focus on the fundamental business. And one of the ways to do it is to gain your market share more and more. So almost 40% of our portfolio is performing much higher than the market. Another 30% is kind of gaining market share. And and our ability to control costs, we have demonstrated in the first 9 months by having 230 basis point increase in the EBITDA margin. So the gap between the increasing top line and reduction in costs has been helping us to drive very healthy margins. And we don't see any change in that trend, at least in the first 2 months of the fourth quarter. So we'll know more in 6 to 8 weeks when we announce our full year results. But mathematically, if you have had for 9 months 230 basis points and you have had 2 months of the last quarter behind you, we definitely think that the 200 basis point increase is definitely possible, albeit the Q4 was a great result for us in the last financial year. So if we are able to match that performance, we should be fine.
Okay. Puneet, I also want to ask you about finance costs. They've been falling rather systematically, a secular fall. You can bring down finance costs even more?
Definitely, Lata, it's very simple. If your EBITDA as an absolute amount keeps going up and your finance costs stay where they were, then automatically the ratios keep improving. And I have no doubt in my mind that we stood at the last quarter at 2.32. We'll see a marginal drop from that coming more closer to 2 than the other way around and going up. So our debt levels are stationary, but our EBITDA in absolute amount and as a margin is increasing, which should help us in all these ratios, including the finance costs.
The other way of asking that is whether you have some capex plans which might put on weight on your debt.
Well, in our industry, we always have capex plans. Typically, the capex would be approximately 5 to 7% of the total revenue, and a few percentage points has become, a part and parcel of any industry because of the speed of change in technology. So I think if you have all these iconic assets, they will only stay iconic if we continue to invest in them, and I think that's absolutely essential and fundamental in driving rates and maintaining that iconic positioning that we have had for several decades and hope to have for the next several decades or even a century to come.
Okay, well, all the best for the quarters to come, and we will try and touch base with you once again post the full year numbers. We hope you speak a bit more often. Thank you for joining us. That's Indian Hotels. It's been a big performer over the last 12 months. But you know what? The biggest performer right now is the market itself. 38,000 has been reclaimed on the Sensex after a period of 6 months. So it's been pretty good going for the bulls. Anuj, does it look like a trend day? I mean, look at the Bank Nifty now, almost 400 points higher.
You know, that's beside the point. The point is, remember the day when it broke out, he said it's a matter of when and not if. 11,500 on the Nifty, and the Bank Nifty, I think, is clearly now looking like headed towards 30,000. And you have to participate in this market. Today morning you should have participated, yesterday you should have participated. Now, it will be fear of missing out. Next time you get a dip or consolidation. And one more thing, don't short a dull market. Yesterday the market was dull. Don't short that, because this kind of market is ready to trap the next set of shorts. My sense is there's more to go, Sonia. You just need to get your hedges in place now. But on the index, especially the Bank Nifty, I think it's just phenomenal. It's been, I think, one of the rare periods. It's almost 2008 reverse. It's just so much money chasing so few stocks that you're seeing this kind of move.
Oh, absolutely. In fact, Yes Bank is now up almost 40% for the year. Who would have thought, right? After so much bad news and turmoil in that company, the stock actually has been the biggest Nifty performer this year. But such is the market. Let's move on to a CNBC-TV18 exclusive. Now we learn from sources that the GST intelligence wing has conducted pan-India raids on tyre manufacturers. Timsi Jaipuria is here with the details. Timsi, tell us, what are you picking up?
Well, sources have indicated that the GST intelligence wing has conducted pan-India raids on tyre industry. Raids are conducted at facilities of both manufacturers and dealers, and the intelligence wing is suspecting tax evasion on account of three different aspects. Firstly, there is a differential rate which is applicable on tyre, tubes and flaps. Secondly, non-payment of taxes, excess claim of input tax credit, and mismatch of returns and invoices. Some of the companies which are under the scanner right now, where government feels where these raids were also conducted, were JK Tyre, Apollo, MRF and CEAT. Now, let me remind our viewers that tyres attract 28% of GST, while the tax was reduced on tubes and flats to 18%.
We got you on a bad line, but we got the gist of what Timsi is saying. The companies being named are JK Tyre, Apollo Tyres, MRF and CEAT. Just pull out Apollo Tyres' intraday chart. That anyway has been a weak stock and is seeing quite a bit of decline. I think even CEAT, that's also been a relatively weaker stock. So that's also seeing a bit of a decline. You wanted to make a point?
Yeah, actually, we have reached out to all of these companies and they have not responded to the query. In fact, some of them have said that they need to reach out to their financial team to get more clarity, because it's a GST issue, tax evasion, etc. So we haven't been able to get any official comment from them. But yes, many of these stocks actually at the low point of trade right now. Apollo Tyres down about 0.2%. Thanks, Timsi, for joining us and giving us this important story. On the other side of the break, though, CLSA has downgraded TTK Prestige to a sell from a buy rating. TT Jagannathan, the chairman of TTK Prestige, will join in next.